Something just happened in the gold market that confirms what many have suspected for years. The fiat currency system as we know it is entering its final chapter, and the evidence isn't coming from conspiracy theorists or doomsday predictors. It's coming from the price action itself, from central bank vaults, and from the very institutions that built this monetary system. Gold just broke through psychological resistance levels that have held for decades. But here's what most people are missing. This isn't just another bull run. This isn't just inflation hedging. What we're witnessing is a fundamental shift in how the world's largest institutions view money itself. And if you understand what's happening right now, you'll see why this moment represents the biggest wealth transfer opportunity in modern history. Let me show you exactly what I'm talking about. The gold market has been sending signals for months that something unprecedented is building. We're seeing accumulation patterns that mirror historical moments right before major monetary resets. The kind of accumulation that happened before Nixon closed the gold window. The kind that preceded the Plaza Accord. The kind that always appears before the rules of the game change completely. Central banks have been net buyers of gold for over a decade now, but the pace has accelerated dramatically. We're not talking about modest portfolio adjustments. We're talking about aggressive, almost desperate accumulation. China's central bank has been adding to reserves month after month. Poland doubled its gold holdings. Singapore, India, Turkey, all moving in the same direction. These aren't random decisions. These are coordinated preparations for what's coming. And here's where it gets really interesting. The COMEX, the major exchange where gold futures trade, is showing something we've never seen before. The ratio of paper gold to physical gold has reached levels that would make any risk manager nervous. For every ounce of physical gold in the vaults, there are claims on multiples of that amount in paper contracts. It's a system built on the assumption that most people will never ask for delivery. But what happens when they do? We're starting to find out. Delivery requests have been climbing, not from retail investors, from institutions, from sovereign wealth funds, from central banks themselves. They're saying, we don't want your paper promises anymore. We want the metal. And when you have a system where 100 people hold tickets to the same seat and they all show up at once, that's when things break. Quick note before we go deeper. If you're watching this and you have retirement savings you're concerned about protecting, I put together a free guide that shows the savings secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Covers strategies most financial advisors won't tell you about. Worth checking out while we continue. Now let's talk about what's really driving this. The fiat currency system operates on confidence. As long as everyone believes the dollar, the euro, the yen will hold their value, the system works. But confidence is a fragile thing, and right now, we're seeing cracks appear in places that were supposed to be solid. The US national debt has crossed levels that were unthinkable a generation ago. We're adding trillions to the debt every year just to keep the lights on. The interest payments alone now exceed the entire defense budget. Think about that. We're spending more just to service our debt than we spend on our entire military. And the only way to make those payments is to create more currency, which means more inflation, which means the purchasing power of every dollar in your bank account slowly evaporates. But here's what the mainstream financial media won't tell you. This isn't a problem unique to the United States. Japan's debt to GDP ratio makes ours look conservative. Europe is dealing with energy crises and banking instability. China's real estate sector, which represents a massive portion of their economy, is imploding. The entire global financial system is interconnected, and when one domino falls, they all feel it. Gold is responding to this reality. It's not just going up because of inflation. It's going up because smart money is recognizing that the end game for this monetary experiment is approaching, and they're positioning accordingly. Let me give you a historical parallel that might help this make sense. In the late 1960s, the United States was running deficits to fund both domestic programs and the Vietnam War. Other countries started getting nervous. They looked at the amount of dollars in circulation compared to the gold supposedly backing those dollars, and the math didn't work. France famously started demanding gold in exchange for their dollar reserves. Other countries followed, and in 1971, Nixon had no choice but to close the gold window. He ended the convertibility of dollars to gold. That was the moment the modern fiat system was born. What most people don't realize is that gold told you this was coming. In the years leading up to that decision, gold was already moving. The London Gold Pool, a consortium of central banks trying to suppress the gold price, collapsed. The free market price of gold was diverging from the official price. The system was breaking before Nixon made it official. We're seeing similar patterns now. The official narrative says everything is fine. Inflation is transitory. The economy is strong. But gold is saying something different. Gold is saying the people who control trillions of dollars don't believe the official story, and they're moving their wealth accordingly. Here's another piece of the puzzle that's absolutely critical. The BRICS nations, Brazil, Russia, India, China, South Africa, have been working on alternatives to the dollar-dominated financial system. They're creating new payment systems. They're settling trade in their own currencies. They're talking openly about a gold-backed trade currency. This isn't speculation. These are official policy discussions happening at the highest levels of government. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales. Think about what that means. For 50 years, the deal was simple. Oil trades in dollars. That creates automatic demand for dollars. That demand allows the US to run deficits that would destroy any other currency. But if oil starts trading in other currencies, if that automatic demand disappears, what happens to the dollar? Gold is answering that question right now. It's saying that the privilege of being the world's reserve currency is ending. And when that privilege ends, the ability to print unlimited amounts of currency without consequences ends too. Now, I want to talk about something that affects you directly. Your retirement accounts, your savings, the wealth you've spent decades building. Most of that wealth is denominated in fiat currency. It's in dollars, sitting in bank accounts, or invested in assets priced in dollars. And if the dollar loses significant purchasing power, your wealth evaporates with it. This is where understanding what's happening with gold becomes personal. Because gold has been the ultimate store of value for 5,000 years. It's survived every empire, every currency collapse, every financial crisis. It's the one asset that central banks can't print more of. The one asset that doesn't depend on anyone's promise to pay. And right now, while most people are still trusting the system, while they're still believing that their dollars will be worth something in 10 or 20 years, the smart money is moving. They're converting paper promises into hard assets. They're recognizing that we're in the late stages of a monetary cycle that always ends the same way. Let me tell you about what happened in Weimar Germany. Most people know the story of hyperinflation, wheelbarrows full of cash to buy bread. But here's what they don't teach you. Before the hyperinflation became obvious, there was a period where everything seemed fine. The government was printing money, but prices were only rising slowly. People trusted the system. They kept their savings in marks. And then, almost overnight, it accelerated. The currency collapsed, and the people who waited too long lost everything. The people who preserved their wealth were the ones who saw it coming, the ones who converted their marks into hard assets before the collapse became obvious. They bought gold, silver, real estate, anything that couldn't be printed. And when the dust settled, they were the ones who still had wealth. We're not in Weimar Germany, but the dynamics are similar. We have governments printing unprecedented amounts of currency. We have debt levels that can never be repaid in today's dollars. We have a system that requires constant inflation just to function. And we have gold telling us that the people who understand money are preparing for what comes next. Here's something else that's happening that you need to understand. The commercial banks, the big players who trade gold futures, have been net short gold for years. They've been betting against gold, selling futures contracts, essentially saying the price will go down. But recently that positioning has started to shift. They're covering their shorts, they're going long. These are the institutions with the best information, the most sophisticated models, the deepest understanding of market mechanics. And they're changing sides. When the smart money changes sides, you pay attention. Because they're not doing it based on hope or fear. They're doing it based on cold calculation of where the risk-reward lies. And right now, they're calculating that the risk of being short gold, of betting against gold, is too high. The technical picture supports this too. Gold has broken out of consolidation patterns that have held for years. It's making new highs in multiple currencies, not just dollars. That's important because it means this isn't just about dollar weakness. It's about gold strength. It's about global recognition that something fundamental is changing. And here's where the supply-demand dynamics get really interesting. Gold mining production has been relatively flat for years. The easy gold has been found. New discoveries are rare. Production costs are rising. Meanwhile, demand is exploding, not just from central banks, from retail investors in Asia who understand gold's role in preserving wealth, from institutions building strategic reserves, from anyone paying attention to what's happening in the monetary system. When you have flat supply and rising demand, there's only one way for price to go, but it's more than that, because gold isn't just a commodity, it's money. It's the ultimate form of money that's existed for millennia. And when confidence in paper money starts to crack, people remember that. Let me give you another historical example. In the 1970s, after Nixon closed the gold window, gold went from $35 an ounce to over $800. That's more than a 20-fold increase in less than a decade. People who owned gold during that period preserved their wealth while inflation destroyed the purchasing power of cash. People who waited, who trusted that the government would fix things, who believed the official narrative that everything was fine, they lost. We're in a similar setup now. The monetary conditions are even more extreme than they were in the 70s. The debt levels are higher. The amount of currency creation is larger. The distortions in the financial system are deeper. And gold is starting to move the way it moved then. But here's what's different this time. In the 70s, most people didn't understand what was happening until it was too late. Information moved slowly. Financial education was limited. People trusted their banks and their government because they didn't have access to alternative viewpoints. Today, information moves instantly. You can see what central banks are doing in real time. You can track gold flows, delivery requests, positioning changes. You have access to the same information the institutions have. That means you have the opportunity to act before the crowd figures it out. You have the chance to position yourself the way the smart money is positioning. You have the ability to protect your wealth before the reset becomes obvious to everyone. Now, if you're sitting on significant retirement savings, if you have $100,000 or more in retirement accounts, you need to understand something important. There are ways to get physical gold into your retirement account without triggering tax penalties. Most people don't know this is possible. Most financial advisors won't tell you because they make money keeping you in traditional investments. But it's completely legal, and it's something thousands of Americans are doing right now. I put together a comprehensive guide on how gold IRAs work. It covers the mechanics, the tax implications, the custodian requirements, everything you need to know. It's in the description below. If you're concerned about protecting your retirement from what's coming, from potential market collapse, from geopolitical instability, from currency devaluation, this is worth your time. It's free, there's no obligation, and it could be the most important financial decision you make. All right, back to what's happening in the markets. Because there's another layer to this that's absolutely critical, the derivatives market. Most people don't understand how large the derivatives market is. We're talking about notional values in the hundreds of trillions of dollars. These are complex financial instruments built on top of other financial instruments, and many of them are tied to interest rates, currency values, and commodity prices. When gold starts moving significantly, when interest rates shift, when currencies become volatile, these derivatives start breaking. We saw this in 2008 with mortgage-backed securities. The underlying assets moved in ways the models said were impossible, and the entire system nearly collapsed. We're setting up for something similar now, but potentially larger, because the derivatives tied to interest rates assume rates will stay in a certain range. The derivatives tied to currencies assume relative stability. The derivatives tied to gold assume it will stay relatively contained. But what happens when all of those assumptions break at once? What happens when gold surges, when currencies become volatile, when interest rates spike because bond markets lose confidence? You get a cascade. You get forced liquidations. You get margin calls that can't be met. You get counterparty failures. You get systemic risk that spreads through the entire financial system. And the only assets that survive that kind of environment are the ones that don't depend on anyone's promise to pay. Physical gold, physical silver, hard assets that exist outside the financial system. This is why central banks are accumulating. They understand the fragility of the system better than anyone. They built the system. They know where the weak points are, and they're preparing for the possibility that those weak points fail. Let me tell you about what's happening in the physical gold market right now. Premiums for physical gold over the paper price have been rising. That means people are willing to pay more for actual metal than what the futures market says it's worth. That's a sign of stress. That's a sign that people don't trust they'll be able to get physical delivery at the paper price. We're seeing delays in delivery from major dealers. We're seeing mints struggling to keep up with demand. We're seeing spreads widen between bid and ask prices. These are all symptoms of a market where physical supply is getting tight while demand is accelerating. And here's the thing about gold. Unlike stocks or bonds or real estate, you can't create more of it quickly. You can't just print more gold certificates and hope no one notices. The physical metal has to exist. And when more people want physical metal than exists in available supply, price has to rise until demand is rationed. We're approaching that point. The signs are everywhere if you know what to look for. The question is whether you're going to recognize it before it becomes obvious to everyone else. Think about your own situation for a moment. How much of your wealth is in paper assets? How much is in bank accounts, stocks, bonds, retirement accounts denominated in dollars? And what happens to that wealth if the dollar loses 20% of its purchasing power? 30%? 50%? History shows us that currency devaluations happen faster than people expect. They happen when confidence breaks. And confidence breaks when people realize that the promises can't be kept, that the debt can't be repaid, that the only way out is to inflate the currency. Gold is insurance against that outcome. But it's insurance that also appreciates when the scenario plays out. It's not just preservation. It's participation in the wealth transfer that happens when monetary systems reset. The wealthy understand this. The ultra-wealthy have always understood this. They keep a portion of their wealth in hard assets specifically for this scenario. They don't keep everything in the financial system because they know the financial system is fragile. They diversify into assets that exist outside the system, assets that can't be devalued by a printing press. And right now, they're increasing those allocations. Not because they're panicking, because they're calculating. They're looking at the same data you have access to. They're seeing the same warning signs, and they're acting on it. Here's another piece of evidence that's hard to ignore: the gold to silver ratio. Historically, this ratio has averaged around 15 to 1, meaning 15 ounces of silver equal 1 ounce of gold. Right now, that ratio is much higher, which means either gold is overvalued relative to silver, or silver is dramatically undervalued relative to gold. Given what we know about silver's industrial uses, given the supply constraints in the silver market, given the historical role of silver as monetary metal, the second explanation makes more sense. Silver is undervalued, and when gold starts its major move, silver typically follows with even more explosive gains. This happened in the 70s. This happened in 2011. This happens every time we get a monetary crisis. Silver amplifies the move in gold. It's more volatile, but the gains are larger for those willing to handle that volatility. The point is, we're in a setup where multiple assets are telling the same story. Gold is breaking out. Silver is coiled. Central banks are accumulating. Physical premiums are rising. Derivatives are stressed. Debt levels are unsustainable. Currency creation is accelerating. All of these factors point in the same direction. Now, I want to address something important. Some people will say gold doesn't pay dividends, it doesn't generate cash flow, it just sits there, and that's true. But that's also the point. Gold is not an investment, it's a store of value, it's insurance. It's the asset you hold when you don't trust the system to preserve your wealth. And in an environment where the system is breaking, where currencies are being debased, where financial assets are at risk, having a portion of your wealth in something that just sits there and maintains its value is exactly what you want. Think of it this way. If your house is on fire, you don't worry about whether your fire extinguisher generates a return. You're glad you have it. Gold is financial insurance. And right now, the house is starting to smoke. The smart move is to position before the fire becomes obvious. Because once everyone sees the flames, the price of insurance goes up dramatically. Once the crowd realizes what's happening, once the mainstream media starts covering it, once your neighbors are talking about it, you've missed the optimal entry point. We're still in the window where most people aren't paying attention, where the mainstream narrative is still that everything is fine, where you can position at prices that will look cheap in hindsight. But that window is closing. Every day, more institutions are figuring it out. Every week, more central banks are adding to reserves. Every month, more retail investors are waking up to what's happening. The crowd is starting to move. And when the crowd moves in the gold market, when everyone tries to get through the same door at once, that's when price really accelerates. Let me give you one more historical parallel. In 2008, before the financial crisis became obvious, there were warning signs. Credit default swap spreads were widening. Subprime mortgage defaults were rising. Bear Stearns had failed. But most people thought it was contained. Most people believed the government when they said the system was sound. And then Lehman Brothers collapsed, and everything changed overnight. The people who saw it coming, who positioned before the crisis became obvious, they made fortunes. The people who waited, who believed the official narrative, they lost everything. We're in a similar moment now. The warning signs are there. The data is available. The smart money is moving. The question is whether you're going to act on what you're seeing, or whether you're going to wait until it's too late. Gold is confirming the end of the fiat system, not through conspiracy theories or predictions, through price action, through accumulation patterns, through the behavior of the institutions that understand money better than anyone. They're voting with their capital. They're moving into hard assets. They're preparing for a reset. You have the same information they have. You have the same opportunity to protect your wealth. The difference is whether you're going to act on it. If you've watched this far, you're clearly someone who takes their financial future seriously, someone who's willing to look beyond the mainstream narrative and understand what's really happening. That's exactly the kind of person who should take advantage of the resources I've put together. In the description below, there's a link to that free guide on gold IRAs and wealth protection strategies. But here's something special for people who watch all the way through. If you mention you watch this video when you reach out, you'll get access to an exclusive one-on-one educational web conference. No obligation, no sales pressure, just education on how to protect your wealth from what's coming. This is only available to American retirees with at least $100,000 in retirement accounts, and it's completely free. The people who take advantage of this are the ones who understand that knowledge is the first step to protection. That understanding your options is how you make informed decisions. That waiting until everyone else figures it out is how you lose. Gold just confirmed the end of fiat. The question is what you're going to do about it. The institutions have made their choice. The central banks have made their choice. The smart money has made their choice. Now it's your turn.